Welcome back. I'm Simon Brown, host of Moneyweb Now. Every weekday morning, 6:30 a.m. You'll find me on the Moneyweb website and, of course, the Moneyweb app. Now, this session we're going to be talking youth and money. And joining me is Elke Brink, wealth advisor at R21 PSG Wealth, and it's something which is a passion of Elke's and mine as well. And I think it was something that was distilled into me. I remember as a very young kid getting my 1.5 cents of pocket money, and I couldn't get it until I justified what I was going to do with it. I was allowed to say I could spend some on sweets, but I couldn't just say I was going to blow it. There had to be a plan. And I think even from that very young age, it got me a little bit smarter than that. Okay, appreciate your time today, really joining us virtually. It is something which is so important. No one denies the fact that money is a life skill, but it's not been taught at the schools. Parents aren't teaching it, with respect to parents, because they weren't taught. I mean, heck, our governments don't even have particularly good money skills.
Yeah, thank you, Simon. Thank you for the invitation. I think there's definitely a big lack in our educational system when it comes to younger people, and I think that should be a compulsory subject in school, to learn about managing your finances and how tax works, and really just planning your portfolios, because it's so relevant to every single person out there. And I think the saddest part of everything is that you lose so much time as a young person, where you can start optimizing a portfolio from the day you start earning an income or even pocket money, where I think a lot of people lose easily up to 10 years of their lives just for the lack of knowledge.
Yeah, it's a great point. Certainly, my mother would ask me questions around the pocket money time, but make no mistake about it, when I got my first salary, I did all the wrong stuff with it. I mean, I did every one of those mistakes. How early? I mean, when do you start? You talk about a first salary. You need to have that knowledge beforehand. I mean, at what point do you start having conversations and age appropriate?
I think as soon as possible. I think it becomes so relevant in high school already, or even if you, I have quite a few clients who actually start off with their toddlers by giving them a little savings piggy and really instilling those beliefs from day one, that you get X amount of pocket money, and if you save for a party you want to attend over the weekend, or a gift you need to buy your friend. So really teaching from the moment that a child starts to understand. And I think that's wonderful beliefs that you can really start from a young age. I think as children get a little bit older, and that I would say maybe high school phase, there are so many wonderful apps and platforms in today's time that really make it easy to understand and to learn. I think easy equities are one of them, where you can play around with fake money, if I can call it that, to just start learning the principles of investing. And there's a fairly relevant new app, it's called Fin Me Up, which I think is really fantastic also, where they are instilling the principles of really weekly updates about investment markets and starting to learn the principles of how do you invest in the markets, which asset classes do you invest in. So I don't think you can start too early.
I'm taking your point, and you mentioning things such as easy equity, such as Fin Me Up, and I think about my niece who would spend, given half the chance, every waking minute on TikTok. Now, let's make no mistake about it, TikTok is also full of crypto and FX scams. But there was a farmer on TikTok who was just doing some sort of basic, and the fact that he was a farmer wasn't the important point, sort of helping people with family budgeting and the like. And I suppose it's going where the kids are. If the kids are on TikTok, well, maybe find a financial person on TikTok. You can teach them some of those skills.
Definitely. I think even if you look at Instagram, or I think, maybe I'm a bit older for TikTok already, but I think if you just follow the right pages and you follow the right advisors or something, it's such an easy platform to gain access to little chunks of information. And I think that's a wonderful way to learn. If you make it more fun, you make it more approachable for younger people, it should be understandable. And I think same for parents. I think it's a difficult lesson to start teaching your child from school on how to be responsible with money, how to really plan what you're doing with your pocket money. Like you mentioned yourself, you always had to have a plan. And I think that's fantastic. I think teaching those principles from the start to this is the X amount you're getting per month, and how are you going to spread it and plan for it. And if it's finished middle of the month, then it's finished. You don't necessarily get more. And I think teaching those responsibilities earlier on will make a very big change. I think that's the saddest part to me, that there's no education system for it. There's a reason only 6% of South Africans can retire comfortably. A lot of us are obviously doing something wrong. We're starting to save too late. We're starting to plan too late. What we are saving, we're maybe not allocating correctly because maybe we don't understand what asset classes are important and what not. So it's also important to understand how to invest and to have these conversations. If you start saving, or if you start investing, how do I do so? And what are the best ways to grow your portfolio?
And I like your point around that. And it occurs to me that, many adults, and I will admit that, my first, X number of paychecks weren't spent responsibly. And it's something I look back and think, I messed that up. But there's an opportunity for me to now speak to my niece and nephew as a parent to say, I didn't do it well, but I know what the problems were. And it almost becomes, and in the blurb I have, it's a life skill. And to use that as a teaching experience with your kids and say, look, this is what I did. And I know that parents are always saying, don't do what I did and that sort of thing. But to engage them and say, I made these mistakes. These are what I did and what I wish I hadn't, and bring that real world experience into it and make it practical and relatable.
Definitely, and I think we need to be prepared the moment you do start working. I think you can learn all these skills about building a portfolio much younger, and I think kids are so tech savvy and informed these days that you can build a resilient portfolio at the age of 10 probably. But I think once you start working and you have access to the tools of possibly a pension fund or a provident fund and being part of these type of investments as well, understanding it from day one and optimizing it from day one can make a major difference in your portfolio. So firstly, just ensuring your portfolio is tax efficient from day one, and just ensuring you're saving enough and you're understanding the principles once you have the opportunity to be a part of it.
So I want to move to that, which is, we've been talking probably more teens and maybe even pre-teens, but now someone's maybe in their early 20s, qualified, gets their first job. It starts at that point. Now, obviously, they work for a large corporate, they're probably going to have some sort of pension or provident money going off. Ask questions around that. But also, at 21 years old, find a financial advisor. You're not rich yet, but you will be in time, but you can use that advice, an expert who can guide you.
Definitely. I think the most wonderful benefit you have when it comes to starting a portfolio is time. And if you can save yourself from making a few mistakes starting off, it already makes a big difference. I think that's something a lot of investors unfortunately do incorrectly when you start off, is investing in wrong type of products, or maybe products where the fee structures or penalty structures aren't optimal. Perhaps you're investing too conservatively for your age, especially as a young person. So I think sitting with an advisor and having those talks that you can really make the right decisions from day one, and you're going to save yourself a lot of time of trying to fix the portfolio later.
And is it even, you mentioned, I would say your biggest asset as a young person is time, because you've got it in spades. You've got literally decades of it, 4 or 5 decades of it. Some of those decisions that you make back there, you mentioned the right products, for example. Those could have real long-term implications. If you take your entire net wealth in January and put it in crypto, you're in big trouble. It's those lessons, but is it also perhaps just the structures? For example, a Regulation 28 product or a tax-free product, which is really about the long-term, really designed for that long-term process.
Yes, I think the investment vehicle is always important, and I think an ideal portfolio would eventually consist out of a few different vehicles. And then it's very important, the fee structures. I think if you can avoid structures that have penalty clauses included, because the longer time you have, then it becomes a downside, because it's very difficult to get out of that product again with time. And lastly, I think the asset classes are very important. I think as a young person, you can be 100% in equity exposure because your term is maybe 60 years long. So you have a very long investment term. And I think that's something that needs to be advised appropriately for the individual. But that's definitely a benefit a young person will have. You have an extremely long investment term to work with, and that also takes off a lot of pressure of you have to invest or how much you have to save, because you just have the benefit of compound interest over time.
Yeah, you got that time, and also it is, and I know that we often think we know it all, and I've been in this industry for decades and learning stuff this afternoon. And one of them, I mean, you mentioned there as a young person, and I've met people in their 20s, and I mentioned it in one of the panels yesterday, who are totally in cash because they've saved money. But the markets scare them, so they don't want to get involved. And you're saying, hang on a second, you've got that time on your side, and that's where the advisor comes in, and that doesn't mean that they can't have some traditional product, Reg 28 and the like. They can still have themselves an easy equities account. They can still go and buy some crypto. It's just getting that balance.
Yes, I think any portfolio I will always advise being diversified. It just depends how much. And I think if you have the benefit of being younger, if you really do the homework and understand how markets behave, and I think that's a responsibility every individual has, even if it's not your main interest, perhaps to focus on finances or investments, but it's so relevant to your future and your life. So reading a bit and understanding what market cycles go through, and maybe you'll feel less risk averse if you really understand the benefit of time. So I think that's something quite important, because I think being risk averse and just being in cash, for example, at the moment, you're almost hurting yourself more.
Yeah, it was the comment that's made many. I mean, cash has risk, and that risk is inflation, which we're currently getting absolutely really plenty of. What about support structures? I mean, we've spoken about a financial advisor, and that obviously is a part of the support structure. But I'm thinking here, sort of maybe siblings, maybe friends, maybe parents or friends of a parent. I mean, you're talking around, high inflation. In many cases, folks are particularly, I'm thinking of Americans. If you're 25, 30 years old, you've never seen high inflation. Yet there are people there who lived through it and absolutely know it. And finding a community almost, I suppose, who you can engage with, who can say to you, don't worry, we've been here before, it too will pass in time.
Yes, and I think that comes back to maybe speaking to different generations and reading up yourself a bit, but I think that's important. Everything has happened in history, and it always repeats itself. And I think if you understand the essence of different asset classes and what the behavioral effect is of it, you'll be less scared of it. And I think that's something to just understand, and to either speak to an advisor or do the reading up yourself, whatever you prefer to do. But I think once you understand it, then you feel comfortable. And I always feel very passionate about that too. I always want my clients to understand why we're making changes to portfolios, or why are we deciding certain things, because I think it's just easier to absorb should a crisis come, because you're going to understand what's going to happen and what is to expect in the future.
Yeah, I like that point. Sort of keep them involved. Not hands-on necessarily, I suppose informed. Keep them informed so that they understand what the logic is and what the process. A question coming through from Mira, who says, parent of teens, how do I get them started with budgeting? Now, as I said, I don't know, my mother just kind of did it. I don't know where it came from. But I mean, if you've got tips for parents to how to sort of introduce it, I mean, is it a carrot and stick, no budget, no pudding, or something like that?
I think it really depends how you want to approach it, but I think the more in detail you can go from the beginning, the better. So perhaps giving your child, depending on what exactly you are paying as and what you are still paying for, but let's use an example. You rather give a higher allowance, but now your child is responsible for paying their cell phone contract and perhaps paying some of their clothes they buy on a monthly basis. So you can decide how much responsibility you want to give, but I think the more the better, to start understanding the cost of living and allocating that on a month-to-month basis. And I think it's a good principle for adults as well. Sometimes we need to go back to the basics and print out 3 bank statements and really see what are you spending and understand where it's going and where it's possible to save a bit more. I would also implement starting to play around with investments or savings from an early age. You can start an investment account and just learn how it's working, start feeling the effects of the market being invested from the age of 16 or 14. I don't think there should be a minimum added to it. But I think, really becoming responsible and learning how to plan. As I mentioned a bit earlier, I think if you have 4 parties this month that you want to attend, and every friend needs a gift and every friend needs a snack or something you take with, you need to plan for it. And if you haven't planned for all the parties, then maybe you should not attend one or plan differently. Again, it sounds a bit harsh, but I think it's important
I take your point.
to also plan socially.
Yeah, I want to come back to the family process, but something which you said there triggered a thought in me, is to a teenager, or perhaps even younger, I don't know, is open them an easy equity account, put 100 Rand in and say to them, go buy something. Because nothing teaches you, all the theory in the world is great, but nothing sort of really teaches you if you bought, I don't know, Steinhoff just before the collapse, or maybe you bought Sasol at the lows of 2 years ago. I mean, that really galvanizes the learning, and because it's small enough amounts of money, worst case you bought a Steinhoff and you lost lots of it, but you get lessons from it, and it's that real world learning.
Yes, definitely. You learn from it, and you learn how the system works. I think you also see the upside of it. If you're having a year like we had in 2021 and you're optimizing your 20% returns on the average fund, then that's also nice to feel. So you can also see the benefit of investing and the benefit of compound interest, and how it really makes a difference, even if you're just adding 100 or 200 a month. So I would definitely recommend that.
Remember, folks, if you've got questions, you can email them, events@moneyweb.co.za. They'll pop up on my phone and we can ask them. And another great question has just come through. What common mistakes have you observed that young investors make?
I think there are 2 things I would mainly say, and I think it applies a little bit more to working young adults already. But the one thing would be if they change employers, and they have the option to access their retirement fund that they cash out, and they feel I've only saved a year or two's funds, I can just use it for something and then start again. So I think cashing out the retirement fund would be one of the biggest mistakes. And I think being invested too conservatively for a young person, and I know it's a personality thing also, being risk averse, which is fine and it should be accommodated, but once again, understanding how asset classes work and the benefit of time, be careful to not just be in cash starting off.
That cashing out, and again, as I said, I made all the mistakes when I was young. I think 25-year-old me left a job and cashed in a retirement fund. And I remember at the time thinking that it wasn't a lot of money. And I forget, maybe it was 15,000 Rand or something, maybe not even that much. But of course, that was 30 years ago almost, or 28 years ago. And that money compounded over the last almost 3 decades would be a lot more than that 12,000. And it was me just not understanding what I was looking at was the honest point. I didn't understand the implication. I was like, this isn't going to change my retirement. Truthfully, it wouldn't have changed it, but it would have certainly added to it. It would increase the quality of red wine on cold evenings.
Definitely. I think if you really just do the calculation of what a year's saving in a retirement portfolio would have done if you had just left it for another 50 years, it's very different. So it might not feel like much, and I think that's also the principle of starting to invest, is don't feel that if you're only starting to save 100 or 200 a year that it doesn't make sense to do it at all. Every Rand makes a very big difference over the long term.
Coming back, and we were answering the question from Mira around parents and helping them. It almost, particularly at that point where they're teens, maybe even a little bit pre-teen, it almost needs to be a family affair, I imagine, in a sense. And there's a budget which the parent will have, but kind of involve the kids. They might not get much, executive voting power on the budget, because of course then it's all going to be pizza and ice cream. But make it that family affair rather than a dictate, and sit around the table once a month and pull apart, as you mentioned, last month's bank statements. Where did the money go? To try and instill them not just the good habits, but I think also that sometimes there's plans and sometimes plans go a little bit wonky. Yes, I think as with any good relationship in life, I think communication is important. And I think
there's a level of respect that comes with it if children understand where money comes from and where it's going to. I have quite a few friends where their toddlers assume that if you have a credit card that it's limitless. So if you say you don't have money with you and they want an ice cream or a coffee, they just use the plastic money. So I think it's important to start teaching a child from early on. We actually worked hard for this, and this is Wayne. And to understand that, like you say, maybe no voting rights from the start, but having the conversation. And like you say, I think also learning how to plan for emergencies from early on, having that few months saving built up. Okay, if you're not working already, it doesn't apply, but having an emergency fund, maybe learning how to save for a holiday or save for something really nice you want to buy. So learning that longer term investing as well. I think that's one of the biggest things younger people deal with, or perhaps all of us deal with, but it's that instant gratification problem. And I think that lesson also needs to be learned from early on, is how to just learn how to save for longer and not touch your funds.
That's a great point, because we've been talking money and budget, we've been talking investing and starting early and using that benefit of time that you have as a younger person. But it's also learning those skills of saving. And again, you might be in your early 20s at your first job and you might think, what am I saving for? But you're going to want a car one day, you're going to want a house one day, you're going to want a wedding one day, and you might not even have met the person or got your driver's license yet, but that doesn't mean that it shouldn't still be a part of your thinking and a part of your personal finance journey, because it's certainly going to hold you in good stead later in life.
Definitely. I think it's important from day one to start learning how to plan for an emergency fund. And emergency shouldn't just always be seen as a negative thing. It can also be used for a holiday or something nice. But learning how to save for that short-term planning, and planning for all the correct things from day one. So I think if you can manage to keep your debt as low as possible, or as well structured as possible, and starting to plan for retirement, and retirement only focused from day one, and having these different vehicles, having your emergency fund or your holiday fund, setting up all the correct vehicles from day one. I think it will just bring a lot of financial peace, and also ensure that you don't have to play catch up later in life.
Does it need to get as complex as because I was starting to think about debt. You'd mentioned that there, and there's different types of debt, of course. There's maybe a student loan to go to varsity. There's a car and a house, and then of course there's the other debt, the credit card, which has in theory no bottom, but of course it has an end point at some point as well. I mean, is it important to bring those in, to bring in things such as a personal balance sheet, or are we taking that perhaps a little too far, and I'm getting too excited by the numbers and spreadsheets?
I think it's important principles from day one. I think a lot of us land snowball effect, where now maybe you have more than one credit card already, and you have a home loan paying off, and you're paying off your car, and it just becomes the snowball effect, where I think ideally, if you could have lived a life where there's no debt, which I think is not possible for the average individual out there, that would have been great. But I think at least prioritizing what type of debt you take on. So maybe something that will be an asset in your life at some point, a home loan, or I guess you can see a study loan or something like that as well. Where credit cards, I would be very wary of, and you're really just understanding where you're optimizing it. And then goes into a next topic is don't just prioritize that, but also prioritize your investment portfolio. I think a lot of younger people also, as they're starting to settle into their portfolios, they just want to pay off their bond, or they just want to focus on this, and then they're not saving in their investment portfolio. Where now you're again losing time, where I would say at least try to prioritize both.
A last question, and I've saved it for the end because it's my favorite question, because it's Thabo. And it starts off, I have just matriculated, and I'm thinking where this is going, and it goes a complete different way. Thabo is way ahead of both of us. I've just matriculated. How many investments should I take out? Thabo's got the whole thing wrapped down. I mean, I suppose there isn't a perfect number. I mean, it's more than one, but the sense is that just matriculated, a couple of months out of school and already thinking about that, which tells me on track.
Yeah, very much on track. I'm very impressed with that. I think the number of investments happen naturally as your cycle goes on. So for example, if you start working at an employer who offers a pension or a provident, you're going to have that forced product. And let's say you leave that employer again, automatically my advice would have been to put it into a preservation fund. So with time, your portfolio will expand, but my recommendation would be to at least try to optimize your tax benefits from day one. And that normally would be a combination of a retirement product and a tax-free investment. But also having a short-term and a long-term type of investment. So long-term would be a retirement product, and that you only really benefit from once you start to earn an income because it's tax deductible. But also having a liquidity type of investment. So that would be a voluntary investment or something that you can access in the short term. So I think it's more that you don't necessarily need many products, but the role they play and the usage in your portfolio differs. So some investments will have tax benefits, but you can't touch them for a long time, where other investments will be accessible immediately, but you also want to use it then only as an emergency fund. You don't want to use your accessible investment as your retirement planning, for example. So I think just defining the different roles and the different goals from short-term goals to long-term goals. And you might only need 2 or 3 different vehicles in your portfolio. I also wouldn't recommend having too many investments because it's just not necessary. You can diversify within that vehicle by using different funds and different asset classes and different managers.
We're going to leave it there. We've run out of time, unfortunately. Elke Brink, Director Wealth Advisor at R21 PSG Wealth, talking youth, youngsters, kids, but also people starting out and how incredibly important it is. And I think there's a responsibility there. And I think a lot of that responsibility sits on us as adults who we made those mistakes. Let's not see them repeated by the next generation. Okay, really appreciate the time today. Small break. We'll be back with the rest of the Moneyweb Better Investor Conference shortly.